The stock market should have crashed 2 years ago, but it didn't. And that delay is exactly what makes this moment dangerous. Right now, millions of Americans are watching their 401ks hit record highs and quietly asking the same question. Should I get out? Every major valuation metric says caution. The Buffett indicator is flashing red. Price-to-earnings ratios are back at levels we've only seen before major crashes. Smart money has been warning about this for years. And yet, the crash never comes. Here's what almost nobody explains clearly. The longer this takes, the more fragile the system becomes. And by the end of this video, you'll understand why the delay itself is the risk, not the headlines. But first, you need to see what's really holding this market together. Let's start with something everyone agrees on. This market is expensive. The Buffett indicator, total market value divided by GDP, is sitting around 180%. Warren Buffett has said that anything above 120% enters dangerous territory. We're not slightly above it, we're far beyond it. The S&P 500 is trading around a PE of 25. Historically, the average is closer to 16. We've only been here a few times before, right before the dot-com crash, and right before the 2008 financial crisis. You already know what followed. So here's the real question, and this is where most people stop thinking. If everyone knows the market is overvalued, why hasn't it broken? Because markets don't collapse when things look bad. They collapse when confidence breaks, and right now confidence is being held together by a few fragile forces. Before we talk about those, you need to understand the invisible support that's kept this market alive. Here's what gets overlooked. For the last few years, the economy hasn't been running naturally. It's been fueled. Massive government spending, infrastructure programs, corporate incentives, defense contracts, debt finance stimulus in dozens of forms. That money doesn't disappear. It flows into businesses. Businesses report higher revenues. Markets respond. But here's the key distinction most people miss. Higher numbers don't always mean higher value. At the same time, the purchasing power of the dollar has been shrinking. Inflation doesn't always feel dramatic, but it's constant. When money buys less, companies charge more just to stay in place. Think about it like this. You run a pizza shop. Last year, 100 pizzas at $10, $1,000 in revenue. This year, 100 pizzas at $15, $1,500 in revenue. On paper, revenue jumped 50%. But did your business actually improve? No. Prices rose because costs rose. That's what we're seeing across the market right now. Nominal growth, not real growth. And Wall Street prices stocks based on reported numbers, not purchasing power. That support works until it doesn't. Right now, market confidence rests on 3 pillars, not fundamentals, but beliefs. And all 3 are under pressure. Deficits are approaching $2 trillion a year. Debt negotiations resurface constantly. Every economist understands this pace can't continue indefinitely. When spending slows, revenues feel it almost immediately, and markets follow. Earnings are still holding up, but guidance is weakening. Consumers are stretched. Credit card balances are at record highs. Savings rates are near lows. Companies are starting to acknowledge it. Target missed. Walmart warned. Even Amazon turned cautious. These aren't crashes. They're signals. For years, investors had no real choice. Bonds paid nothing. Real estate became unaffordable. Crypto proved unstable. Stocks were the only place left. But that's changed. Today, bonds yield over 5%. A guaranteed return suddenly competes with risk. That changes behavior. Institutional money doesn't move all at once. It rotates quietly. Retail investors usually notice last. And when all 3 pillars weaken together, history shows something important. Markets don't drift down. They reprice quickly. Every major crash follows the same psychological sequence. Phase 1, denial. Everyone knows valuations are stretched, but prices keep rising. People stop listening to warnings because being cautious felt expensive. We've lived here for years. Phase 2, doubt. That's where we are now, because see, earnings weaken, spending slows. Alternatives look attractive. Markets still function, but confidence wobbles. This phase can last longer than people expect, and that's why it's dangerous. Phase 3. Panic. One unexpected trigger. A credit event. A major default. A geopolitical shock. No one predicts the trigger. But the conditions are always visible beforehand, and right now the conditions are clearly in place. Here's the counterintuitive truth. The longer a correction is delayed, the more severe it tends to be. Because delay creates false safety. People who sold earlier felt foolish when markets recovered, so they bought back in often with more risk. AI stocks exploded. Leverage crept back. Margin debt started rising again. When everyone is positioned for upside, there's no cushion left. And remember, the spending that supported markets also fueled inflation. Inflation forced higher rates. Higher rates squeeze consumers. They squeeze companies. They squeeze debt-heavy systems. It's not one issue. It's several pressures stacking. This isn't about predicting dates. Markets don't announce turning points. They move from confidence to hesitation to sudden repricing. Most people watching this aren't reckless. They're just trying to protect what took decades to build. And that's the right instinct. So the question isn't, when will the market crash? The real question is, am I positioned to survive a period when confidence breaks? Markets don't avoid downturns. They postpone them. And postponement often increases the adjustment when reality returns. Understanding that cycle doesn't make you fearful. It makes you prepared. In the next video, I'll break down how to position intelligently, what to reduce, what to avoid, and what actually holds up when volatility hits. Because seeing the risk is step 1. Positioning correctly is what separates people who recover from people who never do. Click the next video. Let's talk strategy.